Hey everyone, this is TechCrunch Live, where we help founders build better venture-backed businesses. I'm Matt Burns, and welcome to Columbus, Ohio, home of the Ohio State University, a bunch of startups and some amazing people. And I'm really excited that you're here. This has been a few months in the making. A few months ago, we visited Austin, and now we're doing Columbus, which is one of the fastest rising startup markets in the Midwest. Today's event is all about shining the spotlight on Columbus, and we have an extra extended long episode today that hits all the angles. First, I'm going to talk to Olive, a Columbus-based unicorn and Drive Capital, their first lead investor and the largest VC firm in the area. Olive, I was pivoted a bunch of times, and sometimes pivoting we talk about on TechCrunch is a snap decision, but really the secret is every startup pivots, and it's often hard and painful, and more often than not, emotionally devastating. So that's why we're going to talk about it. Then we're going to have a conversation with Janine Sickmeyer and Wolfstar, local VCs, who are going to help explain how to get funding in the Columbus area. Then we have a panel on jobs, on what startups are hiring, including we have Ryan Landu, Eric Pryor, and Fro, this co-founder and CEO of Beam, a Columbus-based startup that is leading the way in hiring talent. Basically, between these three panels, we have everything covered: pivoting a startup into a unicorn, raising money in Columbus, and then working for a startup in Columbus. But we're not done. We have three startups that are going to present their companies in a pitch-off. And then after that, we are ending the show with a replay of TechCrunch's Found podcast, where Daryl and Jordan speak to Claire Coder, the CEO and co-founder of Antflow, an innovative startup company out of Columbus that just raised $13 million to expand nationwide. And that was a lot. Thanks for sticking through that intro. So let's just dive into this and talk to Sean and Chris from Olive and Drive. Guys, how are you?
Doing great.
Great. Thanks for having us.
Well, thanks for being here. I live up in Michigan, and Columbus is about 3 hours south of me, and it's just an amazing city. And I'm glad to really focus on the area. So are you guys from Columbus?
No, not originally. I did grow up in Ohio. I grew up in a town 2 hours south of Columbus called Gallipolis.
And then Chris, what about you?
No, I'm also not from Columbus. The only person I knew in Columbus when I moved here was my business partner. That was it.
Yeah, I think Chris, you've spoken about this a lot. You run Drive Capital, co-founded it, but you were at Sequoia for about 6 years. Why move to Columbus?
I ask myself that every single day. It's kind of an interesting thing, but the reality is that when I was at Sequoia and was in Silicon Valley, the mentality was that you could only invest in tech companies if they were based within Silicon Valley, and literally meant like the bicycle ride at the office. And the reason for that was that you had engineering talent that was really concentrated there. And frankly, at the time, if you look at what we would invest in, it was tech, it was semiconductors, it was networking equipment, it was tech, and that there was a specialized know-how that was there, and that was the reason that prevailed. Well, right around 2007 or so, cloud computing started to really emerge onto the scene, and suddenly this highly specialized skill set got super commoditized. And suddenly, if you wanted to build a website, you didn't have to be in Silicon Valley. Now you could be anywhere in the world that had an internet connection and a credit card. And so suddenly we stopped investing as much into the tech itself. We started investing into the application of tech with other things. Think about Uber as an example. Is that really a tech company? It's really a taxi hailing application that applies technology to traditional transportation. And so then the thesis fundamentally shifted, where venture capitalists started to really believe that more great technology companies will be built outside of Silicon Valley than in it. And so the thesis was very simple. Let's go to emerging economies around the world and go build new venture franchises. And Silicon Valley at the time was very much enamored with everything west of California, sort of looking at Japan, sort of looking at China, looking at India, looking at South America. These emerging economies were the places that we were excited about. And through some serendipity, we always joke that we ended up discovering this other emerging economy that happens to be east of California. It's called America. And sure, California is super mature from a venture standpoint, but actually everything east of California until you get to Boston was relatively immature and hadn't had that opportunity. And so we had this idea in 2012 that what if we were to go and build take this approach, this West Coast approach towards investing in technology startups and do it in the emerging economy of America. Like, could we build this market defining franchise that would find founders that would historically maybe not even have the opportunity to meet a venture capitalist? Like, think about Sean's story, growing up in Gallipolis. Like, Gallipolis is a long way from San Francisco or Silicon Valley. And the idea that brain power is absolutely distributed equally, but opportunity will be concentrated where the VCs approach and their dollars and put their dollars. And so that was a simple approach that we started with Drive in 2012. And it was this massive research project that I was going through and trying to understand all the, the charts and everything.
And then the research project, tell me about that.
Well, obviously this was a dumb idea because somebody had to have thought of this before. And so, I started looking it up, and, I started trying to understand, why hasn't anybody else done this? And, I had all this data on China and India and these other countries. And we had this concept of like, well, what if these states, like what if Ohio was an economy? Like, how big would it be? Like, what is the GDP of Ohio as a country? There's just a different way to think about things. And you start to realize, like the economy of Greece, for example, almost took down the entire euro several years ago. Well, the GDP of Greece is the same as the city of Detroit. So you start to appreciate things differently and realize that all these American states, if they were countries, they're enormous. And if you looked at like this particular region, we started with the Midwest, it would be the fourth largest economy in the world. It was bigger than Brazil, Russia, even India. But it has a legal system that we know, capital markets that we could access, amazing engineering schools. And that concept has kind of rolled forward. The one thing that was missing was the venture capital. And, we eventually found out that, the reason people hadn't done this before is because it's just conventional thinking. And conventional thinking told you had to do this in Silicon Valley. Whereas if you approach it from a first principle standpoint, you just look at the information. It gave us the opportunity to start the firm.
Now, I need you to put Drive in perspective for everyone, because to me, Drive is the massive overarching VC firm in Columbus. Do you see it that way?
No, I think we're a massive overarching VC firm between the coasts. And, I think that, we didn't start out to be the biggest, but we set out from the beginning wanting to be able to serve entrepreneurs that were basically being underserved. And if you look at like who does that mean? I mean, we started with Sean, was actually literally our very first investment. We actually invested in Crosschecks, that was prior name, out of our own checking accounts because we didn't have a fund yet, because it was really hard to convince LPs to invest in us. But we basically looked at it and said, if we want to actually serve entrepreneurs and be a business partner that could help them build their companies, we'd have to do this in lots of places. We couldn't just do it in Columbus. We'd have to be able to do it basically in the entire geography between the coasts. We'd also have to do it at a variety of stages. So we'd have to be able to develop a seed program, a venture program, a growth program. And over time, we've been able to build that. And so today we've grown from a PowerPoint presentation to our most recent fundraise was $1 billion fundraise. We've grown to $2 billion under management. And, the crazy part is we're just getting started because there are more founders here like Sean that are building these amazing companies, and other folks that you've referenced that are on the panel today. I think we're proving this is not a Columbus phenomenon. This is an American phenomenon. And this is probably what I believe to be the most profound economic revolution in the history of America since the Industrial Revolution. And we have an opportunity to be the lead investor in this economy of tomorrow. So that's what gets us excited.
Chris, I'm going to go get my checkbook. I want to be an LP. Sounds
you
great.
Come on in. We got room.
Yeah.
We got room.
Well, Sean, tell me about your founding story. How did you get a hold of Chris?
So I was actually living in Baltimore, Maryland, and I had spent, the previous 10 years there. I worked at NSA, at the National Security Agency. That was my background, and started my first software company in Baltimore. Ended up selling that company in 2011. And I was really looking for something to do next, but I was sidetracked by this incredible battle that was being fought in my hometown with prescription drug abuse. And, down in southeastern Ohio, it's kind of the, belly of the beast of the opioid epidemic.
Mm-hmm.
And it was seeing a lot of my friends and family members, severely affected by that problem, including the town itself. So I was kind of thinking about ways to help that problem using what I knew best, which was technology and software, to try to fight that fight, and started really commuting back and forth between Baltimore and Ohio to put together a project where we would connect all the systems together in healthcare, the systems that never talk to each other. We would be able to understand who a patient is. We would really create insights where they didn't exist. And when I was doing that, in really bolting these things together, wiring these things together, I ran into Chris and Mark, who were at the early days of basically making a commitment that major companies could be built outside of the coast. And, they happened to be in Ohio when I was there, and we happened to meet, and, they asked what I was working on. And I said, well, I'm going to start a company. I just started a company and sold it. I'll probably do that again. But right now I'm trying to, as I phrased it back then, trying to build the internet of healthcare. It doesn't have the internet, nothing's connected. So I'm trying to connect it all together. And they said, whoa. Why don't you stop building small companies and instead build this into a multi-billion-dollar company, change the entire industry?
What year was that?
This was 2012.
Okay. And now in 2022, 10 years later, how big is the company?
$4 billion valuation. Yeah.
You did it.
Yeah, we did it. We're not done, and we're not, we're still in the early innings, but it's funny because even back then, 10 years ago, they said this will probably take a decade. I thought, a decade? That's crazy. But the thing that was important to me was not only, being able to do something I really passionately cared about, but also building a company that was going to be around for a long time, something that mattered, something important. And really, this other idea was I could actually work together with Drive, who has this thesis that made, massive companies can be built across America in cities that have typically not had that opportunity, and Columbus being the one that we focused on. And the idea was, if you took capital out of the equation, where's the best place in the world to build a multi-billion-dollar company? And we said Columbus, Ohio. So part of it was moving to Columbus, starting the company, and really setting out on this multi-decade effort to build, a franchise that would be able to change the industry forever.
I discovered when we were talking earlier, you guys pivoted a lot, and that's what we would like to talk about. So can you tell me what the original pitch to Chris was, and how was that different than what your company is today?
Yeah, I think, the original pitch was, we are going to focus on patient identity. We had a fingerprint reader that scanned the right index finger of a patient and was able to create a unique ID that would then pull together all of their records and information. And because I had lots of experience in biometrics, given my time at NSA and data and entity resolution and things like that, and identity, it was plausible that I could certainly figure that out with my team. And I think, that the idea there was we were going to connect everything together. That's kind of how it started.
Now, Chris, did you know that they were going to have to change some things going forward when you invested?
You always expect their entrepreneurs are going to have to change something, that, you're going to have to change things. This word pivot that you use, I always find it interesting. It's like the super elegant word for what every time I've been through is a near-death experience for companies. So I didn't anticipate we'd have to go through 27 of them. I also didn't anticipate that Sean would be able to get, venture support and investor support for all 27 of them. And I think that's, testament to him and his ability to continue to inspire people, even when things are bleakest. Because there was, and I think the other thing is is his willingness to constantly go for nothing except for the big vision. There were products along the way that Sean and the team identified that were they were nice products. They would have gotten to, tens of millions in revenue, and the company would have been profitable, and it would have been a very nice company. But Sean and the team really looked at that and said, there's a bigger problem here. And while these are opportunities to make money, they won't actually help us achieve our ultimate vision of raising life expectancy in healthcare, improving efficiencies in the healthcare system. And I think the company's commitment to that vision was really what got them through it.
Now, Sean, that to me, that demonstrates incredible leadership and guidance. How do you keep your team on the same page as you go through these pivots?
Well, I mean, it's really hard. And, over the past decade, I've learned a ton about leadership, and I continue to learn every single day. It's probably the most important, fundamental piece of building a company, especially one that you want to be important and be around for a long time. I think focusing and continuing to stay focused on what we're trying to do and being honest with ourselves from the very beginning that we're not doing this to create a small company. We're not trying to build $100 million company. We're not trying to, create an outcome in the short term for anyone. Like, what we're trying to do is actually change the industry. We fundamentally believe that the disconnection of healthcare, the lack of interoperability led to this extraordinary waste of human capacity. And where today it's 10 billion hours a year of wasted human capacity, and that doing small things was not going to make an impact on that. There's no way that a product that generates $100 million a year of revenue was going to actually be the thing that mattered. So it was really a lot of discipline around swinging for the fences, really being serious about building a multi-billion-dollar company or nothing at all. And that's really the tact we took. And the finding product market fit is a really, really hard thing to do until you do it. Until you've seen it before, until you've experienced product market fit, you don't really know what it's like. You can rationalize your way to say that a product is doing well, and you can convince customers to buy it to some degree. But when you hit product market fit and it is just being pulled off the shelf with this incredible sucking sound, that is unmistakable. And when you find it and you feel it for the first time, that is where all your resources need to go, because that's the product.
We have a slide here that you provided us that illustrates the 27 pivots that you went through. I'm not going to make you talk through all these, but I'm thinking that when you look at this, you as somebody that's done this, a couple of these must stand out as memorable pivots.
Oh, absolutely. I mean, so this chart, and I'm colorblind, by the way, that's why it's all in grayscale. But as the gray horizontal bars kind of reach out into the right side, that's the level of maturity of these products. And some, we had put an enormous amount of resources into. Some of the ones that made its way into the market, were being used by hundreds of hospitals. These products were not just ideas, not something that we just wrote on paper. They were, seriously built and disseminated products. And every single one, had varying levels of challenges associated with deciding not to do it. Building it is one thing. That's challenging, but that's, something we can overcome. And we proved early on that we had a lot of capabilities when it came to building products, and we still do, even better now than we ever have. The real challenge was deciding when not to do something. Sure. And deciding to basically terminate a product, and staying focused on unit economics is critical. Looking at, will this scale? Will this, create enough, enough resources to do big things? And The answer was no in most of these until what we call product 28, which is olive. And by the way, like as we decided to stop doing these products over the course of time, not every single person had that conviction that it was the right move. Some of the ones that were more mature, completely stopping to do them seemed on the surface somewhat crazy. And there were times that people decided that, they no longer wanted to be part of that journey because, it just seemed like it could seem from the inside that it was, somewhat of a radical move to stop a product that is, generating tens of millions of dollars of revenue.
It seems to me that transparency could be critical here and retaining people. How transparent are you with your staff when you needed to change?
Super transparent. I mean, we've always been a very transparent company, and we continue to be a very transparent company. The transparency is not enough, though. I mean, it's not just about saying, here's everything, judge for yourself. It is really about, setting expectations, having the conversations often, and really bringing people along with the decisions. So transparency is good, inclusion is better. And we've just gotten better at inclusion over the course of time. Some of these early things, we were probably very transparent and not very inclusive. So it felt like it was being done to them or being, done with them. I'd say today we've progressed and gotten better at that, but still lots of work to do, and always be.
Now, I'm sure you told Chris along the way that you're changing the company a few times. So Chris, talk me through that conversation. What do you talk to your portfolio companies about pivoting?
It's not a lightly considered decision. It's because it's one of the more frustrating and like it's a really demoralizing thing for a team to go through because they've shipped a product. They put an enormous amount of work into the product to get it into the hands of customers, and people have lost sleep and they have stayed up all night and they have battled to make it as good as they possibly can. But I think at the end of the day, it's as Sean said. I think it's if the team comes to you and says, look, this is not going to get us. We put this in the market and we've proven that it's not going to get us where we want to get to. It's not going to accomplish our goals and we need to shut it down. It's hard to do anything other than support that. And I think, Sean and the team's transparency on this and inclusion on this with the investor base has been remarkable. And it's part of the reason why we kept funding it, why we kept putting more money in when we were there, because on the flip side, as an investor, like I'm not looking for success. The success would be great. It's just unrealistic to expect that. What I get really excited about in early stage companies though, is if you find a team that can get together, that can align on a goal and they can ship product against that goal. If they can do it once, and it's not hard to believe that they could do it again. And I think in Olive's case, they've continued to iterate through that process of improvement and only up-leveled every single time what the product's capabilities are.
Now we have about 10 minutes left. I was hoping we can identify some signs when a startup should pivot or when it's too late to pivot. So Sean, I would like to start with you. What you've done this a bunch now.
Yeah, no, I think that first thing is product market fit, and that gets thrown around quite a lot. But I think anyone who's a good salesperson can sell anyone anything to some degree, right? So like no matter really how bad the product is, or even if it's a nice to have versus something that's critical, you could probably sell some of the folks some of the time. But when you have product market fit, it truly is getting pulled off the shelf. It is absolutely meeting a critical need. It's not you may have heard the analogy of like vitamins versus Tylenol. Like it's a pain reliever, not a vitamin. It is truly something that they can't live without. And once you get that, you know it. And once you've seen it before, it's obvious when other products don't have it. So really understanding product market fit is key. Crossing the chasm concept, which I think people have known about for a long time is an important one. You're going to have the early adopters and the early innovators that are going to adopt a lot of products, despite their true product market fit. When you cross the chasm over to the early minority of buyers, the ones who are very hard to sell, they want a clearly demonstrated ROI. They use a lot of scrutiny in their decision making. When you can cross there successfully, it's a really good sign. So that chasm is called a chasm for a reason, because a lot of products go there to die because they never make the jump. And I think a lot of the signs are going to play itself out in that chasm with your product. And then the last thing I'll say on signals, it's in the numbers. I mean, It is in the numbers. You just got to know where to find it. Like unit economics, and truly understanding unit economics, not because you were told you need to, or because you think it's important for investors to know, but understanding what that means about the product, and what CAC payback really means, and what lifetime value truly means, margin, like all those things are so fundamentally important that the numbers will tell you if the product's a good one or not.
Hey, Chris, same thing. When should a startup pivot?
I think everything Sean said is true. The only thing I would add is I can't remember a single time when we pivoted too early and we looked back at it and said, we didn't give it enough of an opportunity to go in the market. And I think what Sean said is right. Like if you're not seeing that immediate uptake, it doesn't need to be volume wise. I think it needs to be on an engagement level. Like if you ship something and it truly changes the way that your customer does business, you've got something. It doesn't need to be in the hands of 10,000 customers. It just, if you can see that yesterday they did it one way and you catalyzed a different behavior, then you've really got something. And then I think it comes down to the repeatability of that and figuring that out. But to me, it's like a secondary issue. So I think if you put something in your customer's hands, you can see them truly grab it and hold onto it and change what they do. Don't pivot. But if you put it in their hands and then they kind of, you see them drifting back to the old ways that they did something by, the next day, that tells you that like it's just not there. And you need to be willing to also engage with them and ask them, and watch them. More than anything else, watch them. Like for me, I always encourage our companies, go physically sit with that first customer and ask them, can you watch me? Can I watch you use the product? And watch how they use it, because what you will find 9 times out of 10 is this perfectly designed, perfectly engineered MVP that you put in front of the customer is completely interpreted differently than you thought it was going to be built. And suddenly, the buttons are in the wrong places, the functionality does all the wrong stuff, and the thing that you didn't realize that they really wanted was off to the side, and there's almost like a reorganization that goes on to that. So I think if you can see that, then you keep going down that path. If you're not doing that though, then it is time to pivot. And the faster you fail, the faster you're honest, intellectually honest with what your customer is, how they are behaving, not necessarily what they're saying, because they'll never tell you like, hey, your product sucks. But their behavior will describe that to you. The faster you're realistic about that, the better off you are pivoting.
It really sounds like you're saying to follow the customer, not really the market. Is that true?
Absolutely. Yeah, 100%. I mean, look, I think it's easy to get caught up in the world of venture. Every time you get around to funding, TechCrunch writes an article and says that you're great. When you sign a customer, there's no press release. Very rarely there is. And it's hard to remember. Let's put that into context, that like your investors are not going to get you to the promised land. Ultimately, your customers' willingness to pay you for the product, and that is what will get you there. And so I think you've got to hold the customer sacrosanct. The customers go first, then you've got your team internally, then you've got your investors after that.
Yeah. Now, Sean, the last thing on this is there is an emotional toll on this. How do you, or what do you say to other founders?
I would say stay obstinate about the vision or what you're trying to achieve, the broader mission, the bigger focus of the company, but don't be obstinate about the features and the products necessarily. Because if you tie emotion to those products, you're less likely to make a swift decision when the signals are telling you to do that. Really create a relationship with the signals, one that is that you don't want to separate from, but not the products. Like the signals are the truth, and that's what you should flow. That's what you should use to make your decisions.
All right. Last couple questions, and then we got to go to the next panel. But Columbus, we got to talk a little more about Columbus. What's missing from that ecosystem in anything you see?
Yeah, I mean, I think that Drive providing the ability to build multi-billion-dollar companies in the Midwest, in Columbus, and then the Midwest, and now all of the quote-unquote American Valley is critical. But there needs to be more. I mean, frankly, there needs to be more firms who truly believe in building generational companies that are, who are serious about investing in founders who may live in Columbus or Akron or Cleveland or Cincinnati or even in Michigan.
Even in Michigan. Yes.
I think that is absolutely critical. Like, I would love to see Drive have more trading partners in the Midwest and beyond between the coasts.
Now, Chris, it must be hard to raise or find growth partners in the area. Is that right? Where do you have to go for other investments?
Yeah, I mean, we predominantly have to go to the coasts because that's where the next largest pools of capital are. I think it's been exciting. It's grown. Since we first started, the region attracted about $20 billion of venture money on an annual basis. Mm-hmm. Last year, it was about 35 billion. So that's a lot, almost doubling in size. Unfortunately, that on a percentage basis is actually declined. So it's, it used to represent about 25%, about a quarter of all of the venture dollars. It's now declined to 20%. So I keep reading about it on Twitter. I keep hearing about it in the newspapers. But I think, until more VCs move here and make this their primary business and see this as their primary opportunity, we just won't be able to run as quickly as the market will let us. And Drive has done great. We've quadrupled our fund sizes. Last year was a record year. We invested $300 million last year, which was awesome, except that only represents 0.8% of the overall dollars invested here, which is to say that 99.2% of the dollars invested here are coming from funds on the coast. Like, that's a huge opportunity for somebody else to raise their hand and come help us get to really aspire to like 2% or maybe 4%. And if we do that, then I think you're going to see this whole thing accelerate. I mean, it's been really exciting to watch the momentum building here. And it's exciting to see that today it's easier for companies to raise larger amounts of money than it is to raise smaller amounts of money. So the snowball is happening. It is coming. But of course, we're going to be impatient and want it to happen faster.
All right. Well, last questions for both of you. Favorite restaurants in Columbus? Go. Sean, you laugh, so you get to start.
Oh, I'm never good at this question. Chris, you go first. Let me think about it some more. You probably
I gotta go for Third and Hollywood. That's my favorite one over in Grandview.
Very nice.
I'll go with the Top Steakhouse in Bexley because it's
that's a good
old
one.
School.
That's a good one.
Yeah.
Right on. Well, I love talking to other people from the Midwest. I would like to think we're the friendliest people around. So thank you for joining us. Thank you for watching, everyone involved, and best of luck. And Chris, I have it on good authority. You're raising another fund. Is that right?
We closed it. We actually closed it last year. We're keeping up investor relations these days.
All right. Well, best of luck to both of you.
Okay, thanks a lot. Take care. Have a good one. Bye.
All right, folks. Well, next up, that was great. Next up, we have another panel. We're going to talk more about fundraising. And this time we have two venture capitalists speaking with Nisha Tambe. She's our Startup Battlefield editor. We have Janine Sickmeyer and Wolf Starr, and they'll be joining us now. Thank you, everyone.